David, what jumped out at you in this report?
So look, margins fell below 20%, and I think that's where analysts kind of had a floor on this thing. They were 25% not long ago, with all of these price cuts that they've been doing in order to gain market share, keep the plants running, and kind of take a whooping stick to their long-established rivals. They're cutting profits, and at some point, we're going to have to see where Tesla decides they're going to stop with that and go for profits again. But right now, it's all about maximizing their plants. Yeah. It's about keeping rivals out of the EV market and from gaining a foothold, and keeping volume up.
Well, we'll talk about volume, because when you start to see margins contract like this, then there's always the question of, well, why would you go out there and produce more vehicles if you're continually having to cut the prices on the ones that you have? What's the strategy here?
They've got a couple things going on. First of all, this has basically been a monopoly for Tesla. Yes, there have been a few small players out there like Nissan Leaf, Chevy Bolt over the past decade, but up until recently, they haven't had a lot of competition. There is competition now. It's not a lot, but there's more coming. Tesla has a plant in Austin, Texas. It's new. They've been aggressively ramping up production in the first quarter. They've got to sell that production. And they made more vehicles in the last quarter than they sold. That means they're building up a bit of inventory. Tesla doesn't really like to build inventory. They like to sell what they build. They don't have a business model the way the traditional automakers do, so they got to keep sales up. Also, when you do have new competitors coming in, even though they're not here yet, I think they're anticipating some pricing pressure, some sales pressure from the likes of General Motors, Hyundai, Kia, Volkswagen, and they're pushing to get the customers before the new vehicles from those competitors get to market.